You know, I really should plan these things out better. You're gonna have to forgive me if I'm completely out of breath. This morning, I got up and I just got right after it. I jumped into my workout, but as I'm in my workout, I'm thinking, I've also got to get to the weekly note this week and get that sort of packaged up and put together and put out. And so I jumped right out from working out to sitting down to try to talk in a calm, even, measured pace, which I don't think I'm going to succeed at because I'm completely out of breath, but we'll see how I do. I really should learn how to plan these things out better. So yes, we will see how I do this week. If my words are all flustered and turned around and my syntax is all off, like I said, you're going to have to forgive me because I'm completely out of breath. Anyways, good day, everyone. Welcome to the weekly note. This is the GTC Traders Weekly Note for October the 8th, 2023. This is something we release each week here at GTC. If you're new to it, I am the senior partner in a closed private proprietary firm. And we put together sort of a private weekly note, as many firms do, and a daily note. And we just had the thought, how about we do that for GTC? How about we just take from this other firm over here and we just package it up and we release it on GTC. So that's what this is. It's a look ahead. Many firms do this at the markets for the next week, the calendar. If you want a better explanation, we have started to organize these videos into a playlist, the weekly note, on whatever hosting service, be it YouTube, be it whatever video hosting service there is. We're organizing them into a playlist. If you go back and you look at the very first two videos in that playlist, you'll see, you know, the earliest videos, I'll put it that way. You'll see probably a better explanation of what a weekly or daily note is, as well as their value. Why many firms do this. So let's jump right into it. Very obviously, the conflict in Israel is going to weigh very heavily on markets. This is something in highlights as we begin this next week, something I always say. Although events, when they occur and they have an impact on markets, everyone may be able to sit around and say, yeah, it's saddening but not shocking that this happened, but it highlights the non-predictability of markets. And one can say, well, no, you could see that something like this would happen. That's not what we're talking about. When everybody ended Friday, I didn't see this in the news unless somebody else did. If somebody else has a newspaper that gives them the news ahead of time, nobody else saw that, right? In mathematics, we call this discrete quanta released onto a complex system. In other words, there's always new information being released onto the market. It's a very complex system, and it's not predictable. That's not an opinion, that's scientific fact and law. You can work probabilities. We do. We believe in multivariate edge and statistics and probabilities, but that's all it is. But very obviously, the conflict in Israel is going to weigh heavily on markets. Looking at the calendar for the next week, we have some minor Fed officials speaking on today and Monday, the 9th. That's nothing major there of impact. A few auctions on Tuesday. On Wednesday, 8:30 a.m. Eastern Standard Time, we have PPI. For folks who are new, have you ever heard that sort of ridiculous nonsense when ones will say, you know, there's actually been no inflation, it's just all those greedy corporations. And they're just raising the prices on, well, anybody that says that, quite frankly, is an economic idiot. And there's just no other kind way to put it. Every single month, there is PPI that is released. Oh, what is PPI? I am one of those new guys. It is producer price inflation, right? So it's not like the producers and all these corporations just get their inputs for free. It's like, we get all these materials for free and we just charge whatever we want. Of course not. The whole idea is ridiculous. Inflation affects producers as well, right? What they have to buy, you know, fuel to run their trucks, or any number of things. Rise in cost of inflation affects them as well, and we can measure that. Thank God, and again, this is for folks who are new. I know anybody else watching this is like, I'm just interested in your guys' weekly note. Could you speed it up, Dan? But seriously, we do like to appeal to folks who are new as well. Thank God for the derivatives markets. Because for the consumer, for you and I that are going into a store to buy something, the derivative markets helps keep, and traders, by the way, helps keep prices lower than they would otherwise be. These producers, they're being impacted by the rise in cost of goods much more than the consumer. It's there. It's released every single month. You can see it. And what many of these producers do, if they're intelligent anyways, is they go into the derivative market you learn about when you're actually professionally in the markets. But there's a whole basis trade there, and they, short coffee, or they'll either go long coffee depending on what sort of risk they're looking at. Just depends on whether or not they're short the basis or long the basis. Do they have the coffee? If they don't have the coffee, they may be worried about a rise in prices. So it's like, okay, that price is okay with us. We'll buy coffee futures such that if the price rises, well, at least we don't have to pass that all on to the customer, because we can take our profit in the derivatives markets, and that way it softens the blow of the rise of the price of coffee. Right? Oh my goodness, we've got all the fuel for all of our trucks. Thank God there's, good Lord, the energy markets are so deep and complex. But, we don't have that fuel yet. We're worried about a rise in prices for fuel. Thank God we can buy gasoline futures or kerosene, or heating oil, I should say. We can buy that, and therefore, if the cost of our fuel goes up that we need to operate, well, thank God we don't have to pass that all on to the consumer, because we can, if the price rises, well, guess what? We can take the profit there that we got in the derivatives market. It's not really a profit, it's more of a basis hedge, and we can use that to soften the blow of the rise of prices in fuel, be it gasoline, heating oil for kerosene products, and things like that. So thank God. Anybody that talks about corporations are just being greedy, they don't have to raise prices, quite frankly, is an economic idiot. So that's all for folks that are new. We are introducing you to PPI. That is released on 8:30 on Wednesday. And we also have FOMC minutes at 2 o'clock on Wednesday. And then on Thursday, so PPI comes first, and then on Thursday we have CPI. So those are going to be the big ones this week going back. I mean, there's obviously other news releases. We have Michigan consumer sentiment. I'm starting to get my breath back, but I'm still fumbling over my words. That is 10 o'clock on Friday. Looking over to earnings. We have a few earnings that at least stood out to me for the upcoming week. We had, let me think, on Tuesday, October 10th, we have Pepsi. On Thursday, October 12th, we have Domino's Pizza. And then on Friday, October the 13th, we have a slew of financial data. We have Progressive Corporation on Friday. We have PNC Financial Group, JP Morgan Chase, Wells Fargo, and BlackRock. We also have United Health Group on Friday, October the 13th. One might call that a financial as well, but I'll refrain from that commentary. But yeah, a lot of financials on Friday. That's sort of what stood out to me on earnings. Now, let's look at rates. Before we switch over to interest rates, there has been this commentary among financial anchors lately about how the dividend yield for the S&P 500 index has to be so concerned about what's going on with the yield on the 10-year, right? The argument being, well, if the 10-year is higher, then nobody's going to want stocks, right? Because they could just get the yield from the S&P 500 or they could just get the yield from the 10-year, and they don't need that S&P 500 index. And I will say I definitely believe, you can go to someplace like Treasury Direct. I think it's in increments as small as $100. You can get bills and stuff like that with great interest from the government and roll that. That is a wise use of money, right? But there's also a place for dividend yield, because dividend yield and those who reinvest dividends operate in a much larger periodicity, and there's a compounding effect going on there. Can ones use bills, 3-month bills, and just keep rolling that interest as long as it does last? Absolutely. Absolutely. But to say that dividend yield has to be commensurate with the 10-year yield or something like that, I went out and did a little digging. So while we're discussing rates, found this chart, and I posted it in the social media stream. It is a chart from Macro Micro, shout out to them, it's their chart, of the US S&P 500 bond yield spread. So as you can see here, the S&P 500 index can like not care about the spread for a really, really long time, say from like 1995, at least according to this spread, to like 2008, over 10 years. So not really sure it has that massive an impact. On the short term, will it have an impact? Absolutely, right? So when you see rates just rising like crazy as they have before, that's very obviously going to have a short-term impact. But over the long term, I don't know. I thought on the rates front that might be a little interesting. If you didn't catch that we had put that in the social media stream of GTC, there you go. Looking over at the SOFR curve, here we have the SOFR curve. That bend is still at around 4%. It's still around like July of 2025. The bend actually happens around April of 2025. But the main quarter in question, this is the 3-month SOFR, not the 1 month, is from like, well, the next few months to about, I would say, January 2025, April 2025, right there in that window. Everything afterwards sort of just becomes back-end hedge flow. Looking over at the U.S. Treasury curve, again, incredibly inverted. I still see no reason why anybody would want to own bonds. So we're talking 20-year plus. I can't see the point of it. Like, why would you want to get 5.1% when you can just be rolling and getting 5.6% on a 4-month or a 6-month or a 3-month Treasury bill? By the way, Treasury bills are back in futures. That's sort of cool. So I don't care what narrative somebody believes. If they believe in the soft landing, well then again, why would you want to own bonds? That just doesn't make any sense to me. I mean, somewhat moderately priced in that whole scenario at around 5%. So if the front of the curve, you know, we're finally going to go to a more normalized curve, then again, why own bonds? And again, as long on the other side of the coin, if we're still trapped in this inflationary environment, it does become a trap and they still have to raise rates. Again, why would you want to own bonds? I just don't see the place for them. At the moment, that will obviously change at some point, but at the moment, I don't see the place for them. Now, looking at major markets, each week we talk about a proprietary model that we have that looks at just risk assets as a whole. Overall, we are risk off. So as a general, broad, overall bias, we are risk off when we look at that proprietary model we have. It's warning us there may be a buying opportunity soon, but that can take anywhere. And again, this is a tool that looks at things on a very broad nature. That can take anywhere from a single day to a week or maybe even 2 weeks. So that's sort of the zone we're in when we look at that model. We look at something like the VIX, equities, volatility, and specifically the VIX and the peculiarities as to how and what the VIX is actually measuring. We have not cracked that 20 level when we look at VIX term structure. There's nothing jumping out at us on VIX term structure, at least the way we look at it, and we have yet to crack that 20 level. We remain bearish on equities. I would say as we approach the 4,200 level, I would be aware of a situation I call bearish while aware of a squeeze on the bears. So that 4,200 structure might prove to be something. And I think equities last week proves an excellent example of something I want to talk about. Remember, these major market views are in a 0 to 15-day periodicity, right? Well, what did you see the GTC sample portfolio do last week? It bought an equity, DEO. Well, if you're bearish on equities, then why would you buy DEO? Periodicity. Periodicity matters. So DEO, and we've somewhat said this, is part of a longer term process, right? We went very light on the position sizing, first of all. And it's part of a much larger periodicity process that we have. Periodicity matters. So again, this highlights the idea that I've said in that it's bias, not bets. right? You also have to consider what periodicity you're examining for whatever gray box strategy you may be using. Obviously, this week, the conflict in Israel is going to weigh heavily on markets. And for a 0 to 15-day periodicity, we are bearish on equity. But for a process that may last 5 years to 20 years, there are areas where you can quantify that, yes, I want to take advantage of this. So again, periodicity matters. I got to tell you, a lot of people who obviously trade markets know this, but you may be surprised. I discovered in the last 7 years, there are many highly placed individuals and institutions who do not understand the fractal nature of periodicity. I got to admit, it was pretty shocking to me. But again, looking at equities, we are bearish. Be aware there may be pressure put on the bears around that 4,200 structure. Looking at higher dividend, lower volatility stocks, you can view that through something and just think about what that means. We can look at something like that through the specter of the ETF SPHD. Here we have been and we remain bearish on price, bullish on yield. Looking over at Treasuries. Treasuries is going to follow my comments from earlier. On SHY, we remain neutral. Neutral on price, neutral on year, neutral on yield. Very obviously, that's towards the front of the curve. But looking to IEI, IEF, TLT, we remain bearish on price, bullish on yield. And it follows my comments that we had earlier on the Treasury curve. I can't see a reason why you would be buying anything from the 10-year on out. I don't know. Other people have their thoughts, and that's all due respect to them. But for us, we just cannot find a reason to be bullish on price and bearish on yield at all. So from like literally the 5 to 7 year on out, we are bearish on price, bullish on yield. When it comes to commodities, we have actually switched over to neutral. So we are neutral on commodity prices as a whole. This is GSG, but I know GSCI is also very popular. DBC, there's a couple other ones. So commodities as a whole, we are neutral on commodity prices. Looking over at crude oil term structure, it's still in backwardation. For us, given the context of what's going on in the world, especially at the moment, when we look at oil, it's in backwardation on term structure. And even though we've gotten this pretty substantial correction, we actually remain bullish on oil prices. Usually in most situations, I would have gone neutral on oil prices by now, but we are not neutral on oil prices at all. We're just viewing this as a big correction, and we are still bullish on oil prices. Gasoline prices, it's the same. Under normal circumstances, maybe I would turn bearish, but we are not. Even with this, we are considering this a substantial correction, which sometimes you got to take that punch to the face. And again, especially you look at crude oil term structure, you look at what's going on in the world. Normally, I would say we would turn neutral on crude oil and bearish on gasoline, and we're not. We're actually bullish on oil prices, and here for gasoline, we are neutral. Gold, hallelujah. We're finally bearish on gold prices. Love to see that. Cheaper gold prices. So we switched over to bearish on gold prices, and we remain bearish on gold. And looking over at silver, thank goodness, we are still bearish on silver prices. I would really love to see silver down around 1850. That's an area where you may see me thinking about picking up some physical silver, which I do like to do. And of course, 3 guesses as to what our stance is on the US dollar. On the US dollar, we are still very obviously bullish. So that has been the weekly note. I got through it, tripping over my words and out of breath and everything, but I got through it. And our thoughts are just good until they're canceled. And that has been what it's always been. It's simply been our thoughts, not yours, for whatever the heck day it is. As always, stay safe, trade well, and remember that love doesn't cost to die.